Hey everybody, Courtney Smith here, and I want to tell you exactly what happened with Silicon Valley Bank, what the context was, what the proximate cause of the failure was, and how can we make money from it. But first, let's start with some context so we know how we got here. First of all, we know that the Fed had cut interest rates to zero, and that created the biggest bubble in bond market history. So that was the most incredible thing ever. Now, the other thing that you have to remember is that incentives matter. So as I go through this discussion, you're going to hear lots of incentives put in for banks by the government and the Federal Reserve Bank. Now, banks have to post reserves with the Fed to ensure that they can withstand losses. For example, if they loan money to an auto dealer, then they have to deposit money with the Fed, and these are called reserves. So money deposited with the Fed has an implicit cost to it. Now, back in the early 2000s, the Fed and the government decided that mortgages were risk-free. So they said that banks did not have to post reserves. They gave an incentive to banks to lend money for mortgages. And that was the major context behind the Great Recession. As a result of the Great Recession, then, the Fed embarked on a policy of ZIRP, zero interest rate policy, ZIRP, and they kept that until 2019, when they finally started to raise interest rates. Then the COVID crisis hit in 2020, and the government shut down the economy. The Fed went back to ZIRP. Does that mean they went back to ZIRPing? I don't know. But anyway, going back to ZIRP then caused the largest bubble in bond market history. That is the context of the SVB banking crisis. The government says that banks don't have to post reserves if they invest in government bonds. So banks often have an incentive to invest in government bonds. And government bonds are considered as the epitome of a prudent investor. And that's what SVB did. They had a multi-billion-dollar portfolio of government bonds bought at the top of the biggest bubble in U.S. history, sort of like buying Bitcoin at 60,000. Oops. But they were just doing what the government was telling them was prudent. But then last year, the Fed started raising interest rates to combat the high inflation that they were largely responsible for. And that set the dominoes falling. Now, let me digress once more to tell you how banks account for bond purchases, and this relates to incentives as well. There are two bond accounts at banks: investment and trading. So as interest rates went, well, let me explain that. So what happens is the investment portfolio is designed for the banks to put money in that portfolio and then hold to maturity. The trading portfolio is where they buy and sell, and they mark to market the gains and losses on usually a monthly basis, but that's for trading. Investing is hold to maturity. So when SVB bought bonds, I'm pretty sure, I don't know for a fact, but I'm pretty sure most of those went into the investment portfolio, so they don't need to be marked to market. They don't need to show any gains or losses because, of course, the bonds are going to mature at 100, so there's only going to be a capital gain. That's the way the government thinks. That's the way most banks think. But wait. Then they released the information that they had lost over $2 billion and the bank run was on. People got nervous about the safety of their money and started to line up to take out their money from the bank. At the same time, the Twitterati and other social media started to go hysterical. I mean, they posted in all caps. Can you imagine that? Screaming about the problem at SVB. So then the hysterical panic set in. And now the snowball began. People started taking out money, which meant that the bank had to sell those investment treasuries to come up with the cash, which shifted the bonds from an investment portfolio into a trading portfolio where they had to recognize the loss on the bonds, and that went on and on and on. You got what happened there? Sell bonds to make the cash available for their customers, which means that they went from the investment to the trading portfolio, which means they had to recognize the losses on the bonds that they had bought at the top of the biggest bond bubble in history. So that's exactly what happened here. They didn't hedge. All they had to do was to put on a hedging program, and none of this would have mattered. The Fed could hike interest rates, and their losses on the bonds would be offset by the profits on selling futures contracts. In other words, the hedge would have protected them, but they did not do that, and most banks don't. Most banks don't. And here's an example of one where a stupid mistake, a lack of risk management, led to the demise of the 16th largest bank. If they had hedged, they'd still be the 16th largest bank, and instead they're right now the smallest bank in America. So, of course, the question for me as a professional trader is, how do I make money from this? How do we profit from this? Well, we will see more of this type of thing because very few banks hedge their interest rate exposure. As the Fed keeps the heat on inflation, so more banks will likely have to recognize losses, and now people will take their money out much quicker because of SVB. So banks will be under pressure going forward. But a lot of those banks are lending to local businesses, so they will start to tighten credit standards and call in the marginal loans. This will increase the depth and will also move the start of the recession closer to today. That means as a trader, we'd want to sell cyclical stocks. In particular, the regional banks are the big mortgage lenders, and they will stop making marginal housing loans. So look for housing stocks to take a big hit as well. Now, a lot of these ideas that I just gave you are already in the market, so we're a little late here. And I'm not suggesting that these trades right now. You're now going to have to shift to using superior technical trading techniques to time your entries. You're going to wait for rallies and then sell short once you get a new technical trading system, and of course, always use your own tight risk management. Of course, now that's what I've got for you. Of course, please subscribe, like, notify. Let me know what you think of what I've explained here to you in the comments below. Is this useful to you? Because that's why I'm doing it. I'll talk to you later.